This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pachardis. Thanks for joining us at XM.com. It has been an excruciating year for the Japanese yen, which has lost almost 25% of its value against the US dollar, crushed by one of the greatest episodes of monetary policy divergence in modern history. With central banks across the world raising interest rates at an incredible pace, but the Bank of Japan refusing to play this game, rate differentials have widened, devastating the yen as capital flows out of the country in search of better returns abroad. Threats of FX intervention by Japanese authorities have fallen on deaf ears, mostly because market participants view such warnings as a bluff. Solo intervention implies a lower probability of success. It would require a ton of FX reserves and could even backfire, since a failed attempt might give speculators the green light to enter new short bets. With the latest comments from Governor Kuroda suggesting no changes in strategy when the Bank of Japan meets next week, the yen's nightmare is unlikely to end soon. The wind of change seems to be blowing for euro-dollar, which has gained almost 3% over the last 4 trading sessions to escape the parity dungeon. European governments finally seem ready to intervene in the energy market by capping power prices for households, taking some of the burden off the consumer and putting it on the shoulders of the state. Meanwhile, the ECB has decided to defend the single currency by rolling out a 3/4-point rate increase last week to stop the bleeding, and the pendulum in the war has started to swing in Ukraine's favor after the latest counteroffensive. All of these factors have joined forces to engineer a short squeeze in the euro. On the opposite side of the coin, the US dollar is taking a breather after going on a rampage this year. Watch out for the latest US inflation report tomorrow, which will decide how hard the Fed will strike at next week's meeting. Equity markets enjoyed some much-needed relief last week, with the S&P 500 gaining nearly 3.5% to snap a 3-week losing streak as the prospect of a less severe energy crisis in Europe overshadowed the introduction of new lockdowns in China. That said, the near-term path for stocks remains rocky. Central banks spearheaded by the Fed are hell-bent on keeping rates high until inflation is squashed. The pace of quantitative tightening doubled up this month. Valuations are still not cheap, and earnings downgrades are increasingly realistic amid the twin storms in Europe and China. This was today's Daily Market Comment. Thanks for joining us at XM.com.